Hey everyone, welcome back to AWM Insights. It's your Power 3, 2 CPWAs and a CFA. We are Erik, Brandon, and Justin. And headlines continue to be dominated by conversations around the election, tax proposals, and stimulus packages. I think this is something we're going to see all the way through the election. And a lot of our clients are asking the questions of how should my investment portfolio be changed with the potential tax proposals? And so we're excited to jump into that conversation today.
Before we get there, I think everybody's well aware of our affinity for the sustainable. And unfortunately, I think I'm going to have to burn my bummer t-shirt because the Hummer's gone electric. And we're seeing this also as an intersection between sports and business. Again, we've got LeBron repping the Hummer. And, everybody's talking about Tesla right now, but with electric vehicles definitely coming into the forefront, GM's jumping in the game with its nostalgic Hummer and turning it electric. There's reports that the first year production's already sold out. So pretty cool news just to see the transition on that side, and it's definitely in the headlines. And then we've also seen Quibi. This is a company that gained a ton of traction early in the year, raised about almost $2 billion. I think it was $1.75 billion. Backed famously by Jeffrey Katzenberg, the former Disney exec, and then the CEO obviously being Meg Whitman. And they lasted about 6 months in a lackluster run and made the decision this week to actually shut down the company. So I think it's just a good reminder here too. I know we talk a lot about the private markets. Even though they had big backers, they had big leadership, a large amount of money raised. Just a good reminder that there is risk in the private markets with all the hype that we've seen on the IPOs and the direct listings and the SPACs. I think sometimes we forget that private market investment does carry quite a bit of risk. So while Quibi had all the talent, and I'm sure it'll be plucked for other companies, we saw kind of that end come to an abrupt halt this week.
And let's not forget about some important economic data that's coming out right around this time of year. Obviously, we just ended up a quarter, and we're seeing some earnings releases. We see monthly economic statistics released right around this time as well. On the retail sales front, we saw sales climb for the month of September, an unexpected 1.9%. That was above expectations. Definitely a positive sign for the recovery. Unemployment claims on the flip side have been a little noisy. The week prior, they were 900,000. Then as of this recording, we just got unemployment statistics released today, and it was a positive drop to 787,000, which is the lowest level since March. So some continued improvement there. Again, pretty dang high, right? Unemployment still is not anywhere close to where it was, but moving in the right direction slowly but surely. Then, like I said, it's earnings season here, and we're early in earnings season, and about 10% of the S&P 500 has reported so far. Of that, about 86% of those have actually exceeded expectations, another positive sign. The expectations have been pretty negative, if you will, pretty low. The bar has been set pretty low, and so far companies are coming in above that low bar. That all being said, earnings are still negative, right? We're in a recession, arguably, and companies are still struggling with the pandemic and the various closures throughout the economy and throughout the world. But all in all, data seems to be net somewhat exceeding expectations. Now, we always talk about the noise in these short-term data points, and definitely want to underscore that. You can't really draw any specific conclusions from a single data point. You really want to, look at the trend and especially focus on the long term. And then one earning to highlight, just tying it back to the Hummer, the electric Hummer. Tesla actually just released earnings in the last few days and also exceeded expectations and had their 5th quarter of profitability. So definitely something to highlight there.
Yeah, and Tesla's an interesting conversation, right, about making short-term decisions based off of news. It's widely been followed as one of the most popular stocks for what I would say the amateur investor, and at one time it was also the most shorted stock on the market. And so about this part of the episode that we like to walk into is called The Average Joes versus the Pros. really with the framework that we want to help you avoid all of the amateur mistakes that we see investors make, and really equip you with the information of how professionals should approach their portfolio. And returning back to the conversation of how recent news should impact our portfolios, the conversation around the election and taxes, there is this huge scare going on in conversations we're having with our clients of, hey, if Joe Biden is elected, are my taxes going to just skyrocket? And we're literally, I was on a call yesterday and somebody said, hey, should I go to cash? And they're really worried about that of, are these taxes going to eat up my investment returns? And hopefully, the short answer is absolutely do not go to cash. That would be an amateur move.
That definitely would be an amateur move. And while we look at the short-term data, we're long-term investors. We've said that time and time again. Add to that fact that you cannot draw any direct conclusions between who's in the presidency and what the markets are going to do. Both within Democratic administrations and Republican administrations, markets have done good and markets have done poorly at various points in time. So you can't draw any conclusions from that by itself. But most importantly, we think multi-generational, right? We're not just thinking for the short term. We're not short-term investors. Our clients are thinking multi-generational. How do I have my money last beyond me and to my heirs or to a charitable entity of some kind? And we really want to avoid those short-term knee-jerk reactions, because at the end of the day, that's a friction, right? Whether it's from a transaction cost by selling an investment or through triggering some sort of substantial taxable event, even in anticipation of taxes going up, let's say in 2021. Really what we do is look at the long term. We want to preserve that capital, hold it over the long term, avoid unnecessary taxable events, and let that capital compound on itself over time. That is really where you sustain wealth and build future wealth for multiple generations to come, ideally. And just tying it back to the current data, right? When you get so focused on the noise and whether it's quarterly earnings or certain headlines, right? We're all subject to these behavioral biases, most specifically something called recency bias. And we really, really want to avoid that. We want to focus on what we can control. We don't want to make knee-jerk reactions, assuming that, let's just say, for instance, the Democrats are going to sweep this election and there's going to be this so-called blue waves. None of that is guaranteed. And nor do we even know what the actual tax plan will be if Biden gets elected and the Democrats take the Senate. Our tax is going to go up potentially. But again, we want to look at the long term and not make any short term reactions to really permanently impair your capital from compounding over the long term. Then tying that into the overall framework of a goals based, liability driven approach to investing and planning, really is put at risk if you're making short-term reactions, let's call it that. So by reacting to a potential tax change, you are potentially increasing your probability or your risk of not meeting your goals if you're reacting to something without a well thought out plan underpinning it.
Such a good reminder of the difference between taking a professional approach and an amateur approach. It reminds me just of a professional baseball career, right? That focus on the process, focus on the things that you know are going to lead to success, not necessarily what is going on in the news. And so for all of our investment portfolios, control expenses, control taxes, and make sure that we understand what the ultimate goal is, which is achieving outcomes, multi-generational wealth. And I know I'm curious. I know we're all curious of what is going to happen after the election. And to answer those questions, we are hosting a free webinar where we are going to detail post-election what are the changes from a tax perspective and what are the implications for your actual portfolio. And so to sign up for that free webinar, go ahead and head over to awmwebinar.com. Once again, that is awmwebinar.com. And until next time, stay humble, stay hungry, and always be a pro. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.